Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome, everyone, to another edition of Real Estate 360 Live. I'm Ryan Sloper, your host. For those of you not familiar with our program, we do a podcast that broadcasts nationally once a week. We give you the skinny on all things real estate, good, bad, and ugly, or indifferent. This is what is important to us. It's important for us to bring to you the real information that's taking place in the real estate markets, what's happening at the Federal Reserve, how it's impacting home prices and mortgage interest rates, giving you the skinny on everything that you need to know in order for you to make a more informed, educated decision when it comes to buying or selling real estate, buying investment properties, whether it's obtaining a mortgage, trying to get your credit fixed. All these things are covered here. Now, don't expect for this to be a rah-rah podcast where we're really pumping up real estate, because that's just not what we do. I am a real estate agent myself. I have background in finance and real estate. I'm also an investor in it. So you'll hear a perspective that's different from most, because I feel like it's more important for you to be making sound decisions based upon what's going on in the market, what the Fed is actually doing, and how that plays into things, and trying to position myself not only as a real estate agent that's guiding my clients in the right direction, but guiding myself in the right direction. You can check us out, as always, on the iTunes store. If you type in the search box Real Estate 360, you'll see that our podcast is there. I highly recommend that you guys subscribe to that. That way you can get the weekly downloads automatically to your iPhone, iPad, whatever you have. So if you search Real Estate 360 in that iTunes section, you can subscribe to the podcast there. And also, if you like our show, please leave some comments, because that'll help our show grow organically. And if you don't want to go there, you can also go to the website at realestate360live.com. That's realestate360live.com. We also stream all of our past shows right on that website. So you can go there and stream them directly there. On the right-hand side on realestate360live.com, there's an Ask a Question button. That's where I direct everyone, all of our listeners, to go. If you have any questions pertaining to real estate or topics that you would like us to dive into in future episodes, we highly recommend that you do that. Joining me on our panel, as he does every week, is Louis Camerosano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's often cited in the media as a real estate industry expert. He's been cited in the Wall Street Journal, Forbes, Wall Street Journal, Fox Business, U.S. News, MSN, and numerous others. Louis, how are you doing today?
I'm doing grand, Ryan. How are you?
I'm doing fantastic, sir. When we last spoke last week, we were kind of diving into our real estate predictions for 2014. We started talking about, where we saw mortgage interest rates going. We also talked about what we thought the course of home prices was going to be. And this is going to be part two of this two-part series of podcasts where we dive into kind of our predictions for 2014. We left off when we were talking about home prices, and we kind of felt, obviously, with interest rates rising up, with the Federal Reserve coming out and specifically saying that, their goal is not to basically keep mortgage interest rates low, although they're still purchasing ridiculous amounts of mortgage-backed securities. They're basically the lender of only resort of mortgage-backed securities, which has kept them low for such an extended period of time now. But their main goal is to keep the federal fund rate low, which basically allows banks to borrow cheap money and continue to do that for an extended period of time, which is propping up the stock market and everything else. This is going to segue into, what do you feel? So if we have home prices that are going to probably stagnate, and I did want to bring up from the last show, just from doing my local market analysis, and I do a daily video on my local city here, I was going through some new home sales, Louis, and I've actually already started to see that there's been a decrease in the prices of these new homes. And I think that that's a direct reflection of that the demand is actually slowing for those new homes. Now, granted, new homes are priced at a premium to begin with, so they're always priced a little bit higher. But I've seen that really start to tail off, and now we have qualified residential mortgage rule that's set to take place this week, which is going to change the affordability or the ability of a person to obtain a mortgage, because if they're not going to be able to take out as much of a mortgage, if they were allowed to take out a mortgage of plus all their other debts of up to 50% of their gross monthly income, that's now going to be reduced down to 43%. that's going to take a major hit to new home sales. Would you not agree there?
No, I agree 100%, Ryan, because you have rising prices, which means you're already buying less home for the money. Now you have this, and you have rising interest rates, so the affordability goes down, and your ability to buy based on the guidelines and the mortgage rates goes down. And if your economy, your personal economy, hasn't gotten better over the last year, it's far less than a wash. It's not good for you, and it makes it difficult for people to buy houses.
Yeah, and, all the while, the Federal Reserve has made it seem like they've had such an accommodative policy for people to obtain mortgages. While there are people that can take advantage of them, specifically, the majority of those people are investors and or first-time homebuyers that don't currently have another mortgage or that they're upside down in currently. They were potentially able to take advantage of it if they had a consistent job and they had money for down payment and whatnot. But we now have the qualified residential mortgage rule, which is in direct conflict, to me, with what the Fed was trying to accomplish, right? So the Fed started to taper, so now we have mortgage interest rates that are kind of rising. And now we have this mortgage rule that comes into effect, which in essence is actually going to allow people to qualify for less of a home now.
And Ryan, it's against the backdrop of declining mortgage applications.
Absolutely. So the outcome here is that they always go too far. So the regulation always goes too far before they realize, oh, crap, what are we doing here? This is now the housing market is now at a stalemate all over again because we've implemented these rules. We have rising mortgage rates. We've got lower demand for mortgages right now. This could come to an absolute standstill in 2014 if they're not careful. Now, what ultimately do I see happening? I always say that there's always a trend that's going to pop up, and that trend to me, and I talked about this on a previous show, is that adjustable rate mortgages are going to come back into the fold, right? Because if people are able to qualify, if they need to be able to qualify for more of a house, and the only way that they can get there is to have a lower mortgage interest rate, they're going to start to steer themselves away from a fixed rate and go back to an adjustable rate. That's always what typically happens. I don't see any way around that now, considering the debt-to-income ratios restrictions that are going to take place with the qualified residential mortgage rule. So with all that being said, Lewis, we did kind of a recap of last week's show with the podcast where we said that home values in metropolitan areas, they may go up a little bit. In other areas, they may start to decline because there might not be as much of a demand, especially with rising interest rates, especially with the employment situation not getting better. We do have a little bit of stability now, knowing that there's probably not going to be another government shutdown because the budget was extended for 2 years. Lewis, is that correct?
Yeah, but do you think that really impacted the way they shut the government down? It didn't really impact the housing market anyway.
No. You know what? I think it impacted it in the short term, meaning that just people.
Well, the pipeline was slowed down because there were certain data they couldn't access to process mortgage applications. But I don't think the people were concerned that the Lincoln Memorial was shut down and that forestalled their home buying process.
No, it just affected the statistics probably for the closings that were going to take place.
What you're saying is that's been removed. Okay. It's not like it's an impetus to spur on home sales because there's not going to be a government shutdown.
No. And, but the way the media pumps the shutdown, that there's not going to be a shutdown now, is now we're going to have, we're going to have more stability. So,
sure.
And the Federal Reserve looks at that as there's no fiscal threats now, and that, there should not be the economic headwinds that we had before. Things are starting to clear up.
That was Bernanke's point. Was he was kind of in his speech, he was commending Congress for not mucking up the works there. Okay, that's not really a positive thing that they didn't do harm.
Right. Yeah, I mean, it's incredible the way that this is all playing out. And obviously, Bernanke's on his way out. To me, not really having accomplished anything other than his legacy to me is not only bailing the banks out, but making the banks rich again in record time, right?
Right. My epitaph on him is he printed and ran.
Yeah.
That little quick taper on the end, but basically his whole tenure was marked by massive money printing. And he called it money printing on 60 Minutes. He later tried to backpedal and say it wasn't money printing, but he also said in congressional testimony he wouldn't monetize debt. He did monetize debt. So basically he went in and just cranked the printing presses 24/7, and his whole remembrance in his mind is that he saved the world from economic collapse, and he left the economy in better shape than he found it.
Right, and now we're going to consider the economy in better shape mainly because we see the stock market propped up as high as it is, right? That's his basis for saying that the economy turned around. Not really factoring in what's really taking place in the employment, right?
In employment, and also because housing prices are higher. We know the reason housing prices are higher. Inventory is so low, and inventory is so low as a result of the hangover from the last housing bubble. So many people are underwater, they can't sell. So the only reason housing prices are going up isn't because there's a roaring economy or a roaring demand. It's because half the people are investors taking advantage of low interest rates, and they're chasing a low inventory. And the average person isn't out there with stars in their eyes hoping they can buy a home in the next year or two. It's a very difficult economic endeavor to go through to try to buy a home. And it's no easier now than it was 2, 3, 4 years ago, and there's not more people in a position to buy it, and particularly the young people, Ryan. The last 5 years haven't been kind to millennials who are starting out. You know, you read these stories all over the place where many millennials are living in basements of their parents and have part-time jobs or no jobs, and there's just not a pipeline there for people to buy homes. So Bernanke didn't do really anything other than entrench and enshrine the existing failures, the too big to fail banks.
Yeah, I agree with you. And so going forward, obviously, the people you want to listen to our predictions for mortgage interest rates and home values, please go back and download our last episodes. Now we're going to transition to, the stock market. We have the Dow right now at 16,440. We have the NASDAQ at 3535, S&P at 1829. We have the 10-year yield at 2.97. Where do you see the stock market going for the year 2014 as a whole? Are there going to be any sections of the stock market that you think are really going to pop out? Is it going to be stagnant? What is your take on the overall stock market conditions for 2014?
Well, both the stock market and interest rates, unfortunately, are going to be driven 100% by whatever the Fed does.
Yep.
Absent the Fed, the stock market would be as high as it is. Interest rates would be far higher. The whole economy over the last 5 years would have been dramatically different had the Fed not intervened on a massive scale, printing $4 trillion in the form of QE to buy mortgage-backed securities and U.S. Treasury bonds. So it depends. Now, if they continue with tapering and they're serious, which I think they're not quite sure what they're going to do, but let's say they go on a taper spree and Yellen uncharacteristically gets hawkish and at every successive meeting shaves off $10-20 billion off of what they're going to spend each month on mortgage-backed securities and U.S. Treasuries, and the stock market gets the sense that the Fed is serious and they're going to do that, well, then interest rates are going to rise and the stock market will have a major correction or major crash. There's no avoiding that. Now, the Fed knows that, Ryan, so they're not just going to say taper on and start slashing their purchases and allow that to happen. However, that could happen anyway, Ryan, as they perhaps try to pull a taper and the markets get nervous that the Greenspan put, the Bernanke put, has now been removed because Yellen isn't going to backstop the markets. So it really depends, and I don't see Yellen removing the Fed's put behind the market, meaning that's what the Fed exists for, or that's not what they exist for, but that's what they've served as the last 30 years, is basically to pump liquidity into the banks and into the stock market to make sure that we never have these long corrections and these long periods of time where the stock market languishes and the banks don't do well. So They will do anything they can to avoid it, but as we've discussed, for 4 years now, Ryan, they're in a dilemma because they've kind of reached the limits of what they can do, because if you go back to what Greenspan did, his toy was always, or his tool was always lower interest rates whenever at any sign of trouble, and then put liquidity into the markets kind of on a targeted fashion, but not all the time. So you had Greenspan, low interest rates. Bernanke comes in, does no interest rates, and then floods the market with more money than Greenspan even thought existed through quantitative easing and $4 trillion. it's kind of hard to top that for Yellen. I mean, she can go from low interest rates to no interest rates to negative interest rates. But how much further can she go? There's not much more money she can print without totally losing control of the U.S. dollar and printing it into oblivion. So I think the Fed has reached its limits as to what it can do to prop up the stock market. So whether they taper or don't taper, the stock market's on shaky grounds because it needs that federal liquidity, Fed Reserve liquidity in the form of QE to stay high, but also the Fed really can't afford to continue with the QE because they've already signaled that they need to end it. Everyone thinks that they need to end it. It's not really helping the economy. They already have $4 trillion worth of garbage on their balance sheet, which at some point, not only do they have to stop buying these treasuries and buying these mortgage-backed securities, they got to sell them. Well, before they even begin to sell them, when they stop buying them, who else is going to buy them?
Well, that's what I was going to say.
The Chinese have already signaled their intention not to add to the reserve. So the Fed has a problem. They kind of almost have to continue to buy them. They already have too much of this junk. They have to look towards starting this to stop buying them and then to start selling them, but they know they can't do that. So it's going to be very interesting to see how they're going to extricate themselves from this while still putting money into the system. And that's what we talked about last week, Ryan. We talked about they'll just go after, they'll use bail-ins. They'll somehow get other money elsewhere that they can't print, and that can come in the forms of requiring people to purchase U.S. Treasuries as part of their retirement accounts, to make up for the shortfall for what the Fed doesn't buy. Who knows? But they can't continue QE, and they also can't stop QE. Either way, the dollar or the stock market gets a hit. So I don't know what's going to happen in 2014. It all depends on what the Fed does. But we do know that what the Fed does, when they do it, we will know exactly what the reaction will be. We just don't know what Yellen is going to do.
Yeah, we don't know what she's going to do, but she's kind of said what her views are on it. So that's kind of what I'm going to base my prediction off of, is that she is going to continue down the line of what Bernanke did, if not even more aggressively.
But can she, Ryan? The question is, there's $4 trillion on the balance sheet already. Can she
continue? I think the numbers don't really matter, though, Louis.
Yes.
You know what I mean? Like, to them, I'm convinced that, whether it's $4 trillion or 14 or 40 or 400 trillion, what does it really matter at this point? Because, like you said, they're in a catch-22 at this point.
Oh, absolutely.
They can't really afford to keep doing it, but then they can't they
right.
can't stop it either, because who's going to buy up all these treasuries and mortgage-backed securities? There's nobody there. So the minute that they really stop doing that, mortgage interest rates go to 10%, and their treasuries, basically, the government can't pay back its debt any longer, right? So
you see, that starts to solve the problem, though.
It does start to solve the problem, but people
they're not going to do that, though.
But they don't want to feel the pain associated
right.
that would come from that, and that's the biggest issue here, is that we know that they don't want to have any pain, so they'll continue to do whatever they possibly can, which might be just another form of quantitative easing called something else, like we've mentioned numerous other times.
Right.
Maybe, start to have the public start to fund a lot of this by taking these 401k plans, retirement and pension funds, and start buying up all the junk that they're pushing out there, so they can say, hey, we're going to pull back another $10 billion, and somebody else is going to pick up that $10 billion, right? Because it can't just go. Somebody has to buy it. But I really feel like it took us how long to get them to finally pull a $10 billion taper, right?
First, they haven't even done it yet.
But yeah, that's what I'm saying. It took us years and years and years and years for them to even start to pull back anything.
It's not even a taper on, because we talked about last week. They're reinvesting all the interest on the stuff that they bought over the last 5 years, which amounts now to $10 billion a month. So all they're doing is the equivalent of not reinvesting the interest. They're still buying $85 billion a month.
Right, so it was 85 to 75, but if you take the interest they reinvested, it's back to 85. So it's the same exact thing that they were already doing. So there is,
and the balance sheet is still growing. They still are adding to their $4 trillion garbage balance sheet.
Right, so there's no net change to the balance sheet. There's probably not going to be any type of change in the foreseeable future. So knowing that, and knowing that Bernanke on Friday once again came out and said that they're committed to keeping that federal fund rate basically at zero, near zero, below zero, who knows?
Right.
I don't think that the stock market has a choice but to stay where it's at, if not a touch higher. Now,
well, that's what they want. They would hope, but that's, then you get into what's your prediction for 2015. How long can they string that along?
Well, see, that's where I think that things will start to change just a little bit when, obviously, then we start getting into presidential elections again. Remember, my whole thing all along is that nothing bad is going to happen on Obama's dime.
Correct. Right? That's been your position.
I'm sticking to that. I really do feel that nothing bad is going to happen on his dime because his legacy cannot be tarnished.
Well, it's not just that, because then the next president who comes in can do exactly what Roosevelt did, is impose the, in a way, it's kind of what happened after Bush. Bush leaves, there's a financial crisis. That gave Obama the ability as a new president to come in and institute the stimulus.
Absolutely.
QE. Obama leaves, there's a financial crisis at the end of his term. The new president gets to come in and do who knows what.
Yeah, so that's where I really think stuff starts to unravel, is at the, probably middle end of 2015.
Do you think they can keep this going through the year?
I do. I'm convinced. Because we already know that the Chinese, right? We already know that the Chinese are basically saying that, hey, they're buying up gold left and right now, right? They're buying up all tangible assets they possibly can, and they want nothing to do with the United States. And that's going to be a common theme that other countries are going to take the same stance. So,
well, they've already taken it. I mean, they're trying to make arrangements not to use the dollar.
Absolutely. So, and the only option that we have to continue this madness is to continue to pump liquidity to the markets, which is exactly what the Fed plans on doing.
Right. It's not just the money is not needed just for the banks. They need the low interest rates because the government hasn't made any steps towards reducing. They made steps towards reducing the deficit, but they still owe so much money that the interest on the debt, you can't afford to pay it if interest rates rise.
Well, and let's say this: they've made an attempt to reduce the deficit over a 10-year period. When are they ever going to make an attempt to reduce the deficit in the short term?
Because the politicians, again, it's just like they don't want it happening on their dime. If you're in the Congress that slashes spending and reduces the deficit in a meaningful way, you are going to harm the economy in the short term, and you're going to harm individuals who are voters who are going to vote you out immediately.
Yeah,
you're not going to cut someone's Social Security benefits. You're not going to slash the federal government spending such that the GDP goes negative. In 2 years, whenever that next election comes, you're out.
Yeah,
and you can't use, hey, it's in the best interest of the overall economy long term. You're going to have many angry voters who are relying on all the government largesse.
And so
that's why they can never cut.
They can't cut.
The point that Romney made, he made it inartfully, but it's true. The more people you have that are dependent upon, or in favor of government programs, you really can't cut them. And he was wrong to say that it was, 46, 7%. It's probably 70%. Because if you take all the corporate welfare, you put in the farm subsidies, you put in the food stamps, you put in the welfare, Social Security, Medicare, pretty much you start to impact just about everybody, other than somebody who's, totally self-sufficient, who doesn't rely on the government for anything. So it's very tough to cut. Because once you start to cut one area, the other people say, wait, why are we cutting mine and not yours? And they're never going to agree. What they end up with politicians agreeing is not, okay, well, I'll cut this if you cut that. They'll say, I won't cut this if you won't cut that.
Right.
And it never happens. And each year it gets worse. Now with Obamacare, that's another entitlement.
Well, and that's what I was going to say. And we pretty much already mentioned in a prior episode that we said that obviously the next election is going to be run strategically on Obamacare, right?
But it's not going to go away.
Yeah, it's not going to go away. It took too long for it to even take place, and it's still a disaster. All that leads to less disposable income for people, right? Because
absolutely, they got to pay higher premiums. Or what about people who don't even get insurance? They're going to have higher doctor bills because their insurance didn't go through.
Higher doctor bills. It's not getting cheaper. Medical care is not getting cheaper in general, and then insurance rates are going up, and then we have rising mortgage interest rates. There's not really...
You might even have insurance bailouts that they're talking about now because, if an insurance company has to take on all these people with pre-existing conditions and has to pay out more in claims than they bring in premiums, well, they're going to need a bailout. Because if you don't have insurance companies, you don't have Obamacare. They're not going to let them go out of business.
Bailouts seem to be the common theme here. So
bailouts, bail-ins, right?
Right. I mean, so we wouldn't rule that out. But with all that being said, Lewis, yeah, I still do believe that this train will continue through 2014. Now,
I think the wheels are off. I don't know how it's running. It's running on fumes with square wheels.
I don't either. That's what I'm saying. My logic.
But you think it can continue based on the momentum it has?
Yeah, and based upon the artificial momentum that the Fed has created and that Wall Street itself has to buy into. Because, I mean, who's going to be the big investor that comes out and say, I'm pulling all my money. I'm going to support. I'm going to.
Well, that one has an interest in that. Ryan, in 2011, we were talking on our show on CBS Radio, and the reason gold and silver, which is probably a good segue now, were rising so rapidly was smart money was thinking, this is crazy. This is insanity. The Fed will never be able to pull this off. They're printing money. You can't print your way out of problems. Disasters around the corner. By 2012, this entire economy is going to collapse. And then it didn't. And it didn't happen in 12. And it didn't happen in 13. You have all the Keynesians patting themselves on the back, calling people crazy for wanting to buy gold, saying that these people are just paranoid, living in their bunkers, and so on. And, after a while, the crisis doesn't happen. It gets pushed off. That doesn't mean that it's not going to happen. It is going to happen. It just means they've managed to delay the reckoning.
Yeah. I mean, I agree with you 100%. And my thing is that we know that all the big banks are the ones that are really pushing all the money into the markets, right? So they're the ones that sit around the table with the Federal Reserve and basically determine what's going to take place all the time.
The shareholders.
So what are the odds that they all get on the same page that all of a sudden that, hey, I think this, stock market's way overbought at this point. I think we should start buying up some gold and silver and push those prices higher. Well, you know what I mean?
That's not in their interest because the amount of money, well, actually, I take that back. What I was going to say is that paper assets to banks are far more advantageous because you can lend, hypothecate, do derivatives off of, you can do fractional reserve banking. You can continue to multiply your gains beyond the physical supply. Now, they've managed to do that with gold anyway, through the trading on the COMEX, through short selling, 50 times the world's supply in a 1-minute trade and so on. But they're not really interested in hard assets because, as we've seen even with real estate, hard assets become a liability because you then have to foreclose on them and go get them and then maintain them. So the banks are much more in favor of digital money. They're in favor of paper money, things that they can trade and control. They don't have to warehouse it. They basically, money just flies all over the place and they grab a piece of it.
Well, wouldn't you agree, though, that, where we're at now, our dollar should be basically worthless at this point in time? And that, that gold should probably be double or triple or quadruple where it's at right now. I mean, realistically, if it wasn't manipulated by the markets, should we not have gold and silver at least 2 times higher than where it's at right now? If
you didn't have the United States as the world reserve currency, if you didn't have the Fed defending the dollar, then clearly gold would go higher. Now, if you think about it, if you go back to the history of gold, since they made it legal to own in the United States, gold skyrocketed in the late 70s when we had inflation, we had massive government spending, we were off the gold standard, people wanted hard assets, gold and silver soared to record highs, I think $800 for gold by 1980, and $50 for silver by 1980. Then the Fed had Paul Volcker, who I think was appointed under Carter and continued under Reagan. He went ahead and ratcheted up interest rates, and if you remember this, if you're old enough to remember it, up to like 17, 18, 19% in order to nip inflation in the bud. Well, that strengthened the dollar. It caused a major recession. Reaganomics, there was a very bad, it got worse during Reagan's first term, the first 2 years, than it had been under Carter with massive unemployment. But when all that cleared, that paved the way for the economic revival of the 1980s. And when that happened, gold and silver then were relegated to assets that were under-owned. Gold fell from $800 down to $200, silver back down to the single digits. It wasn't until the end of the dot-com bubble that gold and silver started to, move up again. And they moved up because after the there was no reason to be in gold or silver in the 80s when the stock market was roaring, in the 90s when the internet revolution was taking place and you could make a fortune in internet stocks. Gold and silver started to move up when people saw the reaction to the dot-com burst, Bernanke, Greenspan's reaction to lowering interest rates. So for the last 12 years, when under the Greenspan-Bernanke highly accommodative monetary policies, gold and silver have, reestablished, or at least gold has blown past its high of 800, went from like $300 in 2000 up to $1,900 in 2011. It's still at $1,230 today. And that's clearly a result of a reaction to the monetary policy. Silver did the same thing. Now, if it wasn't for the Fed's loose monetary policy, gold would never have gone that high. If Nixon hadn't taken us off the gold standard, gold would never have gone that high either. But right now we're in a situation where people jumped on the gold in 2010 and 2011 as a speculative asset. They were buying it or trading it like it was a stock, and these gold ETFs encourage that type of investment behavior. The problem with ETFs are they end up being the source of manipulation for bankers to lend, hypothecate, do derivatives off of, and not have to actually have the physical gold available at all times. So what's happened over the last, and this leads into my prediction for 2014, is we saw investor sentiment sour on gold in the United States in the last 2 years, solely because the price went down. If the price is going up, you want it. Like Bitcoin, if it's going down, you want to dump it, especially if there's other places to put your money, like the stock market, which is going up. Right. So people traded gold, and they moved out of it when the price came down. So what happened with the ETFs, with gold, they lost 25-30% of their physical holdings. Well, where did that go? That went directly east to China. Remember, Germany wants its gold back. There's a great demand for physical gold. The COMEX vaults apparently are empty as well, even though gold is trading low. So you've got a great demand for physical gold, especially in the East. At the same time, you have a lower price for gold on the paper markets, and then you got miners reducing their output because the price is low because they can't afford it. So basically, there is a shortage of physical gold, even though the price is low. It's moved east, and investor sentiment in the U.S., at least at the retail level, gold sales at the U.S. Mint, the Perth Mint, the Canadian Mint, the Mexican Mint, were fairly robust in 2013. And they were extremely high in India and China, even though India tried to forestall the sales. Now, that means that gold is highly valued, but the U.S. has kind of managed to, through ETFs and through pushing the stock market, make it an unfavored asset. But you have to keep in mind it went up for the last 12 years. Now, if you move over to silver, silver is an even more interesting story, Ryan, because silver is such a tiny market. And silver, I think it's a $16 billion market. There's only 800 million ounces produced in a given year. So at $20 an ounce, you're not really talking about that much silver. Now, silver last year at the retail level hit record highs. You had 44 million ounces of silver sold at the U.S. Mint, far more than any of the other years, even 2011. The Canadian Mint, the Perth Mint, all of the mints that sell silver coins, silver rounds, had record years. Even the silver ETFs did not show much in the way of outflows. And yet, the silver price was down, 35-40% in 2013, even though the retail sales were up. And again, the miners have difficulty making money at these prices. And Mexico, the largest producer of silver, just instituted a tax on silver mines. So the production of both gold and silver is going to be down in 2014. I don't see a reduction in the demand. And then, of course, you got to remember silver has industrial use. I think 50% of silver's use is industrial, and that's the use for electronics. All electronics have silver in them in some shape or form. And silver is also used in the making of solar panels. So silver's in great demand. Silver's cheap. It's $20 an ounce. It was $40, $50 an ounce in 1980. It averaged $35 an ounce in 1979. It is absolutely astonishing that you have a commodity right now that in 1979 was more expensive than it is now. I mean, gas in 1979 was 75, 80 cents a gallon. I can't think of any commodity or anything that is cheaper today than it was in 1979, other than things that people don't need anymore.
Right.
Maybe like an 8-track player. So I really think this year in 2014, gold should go back to the $1,500-1,600 level, and silver really should be in the $35, $40 an ounce, no problem whatsoever. Whether the Fed tapers, doesn't taper, just on the fundamentals on the supply and demand. What are your thoughts?
That was pretty much my thoughts too. I feel like that regardless of what the stock market does, I'm glad you just mentioned that, whether it goes up or down or whatever, that naturally these prices have to go up for gold and silver. Yeah, I feel like they're, with record sales coming in, you know what I mean? Like you said, silver at $20. I mean, it is really astonishing, but almost everything that we talk about with this economy is astonishing, right? I mean, it's mind-boggling what's actually taking place. There's the fundamentals that economists would sit there and look at. They don't add up to anything. Like they'll say that if X plus Y equals this, that's not what's happening here. You know what I mean?
Right.
We have anomalies going on all over the place, but it's all because of the Fed. It's the manipulation of the markets that we have this.
Not just what's out in the open with the manipulation and setting interest rates is probably the greatest example of market manipulation you can even imagine, because it's out there in the open, and then buying mortgage-backed securities, not just setting interest rates, but then actively participating in the market. There is no bigger player in the market than somebody who buys $85 billion a month of anything, and that's what the Fed does. So don't think it ends there. Of course they interfere in all other markets to make sure that their ultimate goals are being achieved. They don't want gold and silver prices to go higher, because that's a canary in the coal mine that there's something wrong with the economy. Greenspan called owning gold a hedge against what he calls tail risk, bad outcomes, and that if gold is going higher, that means people think there's something wrong with the economy, there's something wrong with the Fed. They don't want that.
Right. And, it's interesting because you mentioned that the banks and everybody else is always looking for something else to invest in that they can hypothecate and really manipulate, right? So they're not really able to do much with gold and silver here.
Not the physical.
Not the physical stuff. So now they've also started recognizing virtual currencies like
Correct.
Bitcoin, right? Which they can hypothecate on those type of currencies.
Well, they would rather, and they can get away with market manipulation and Bitcoin. I think that the libertarian Bitcoiners are delusional, thinking that somehow they've created something that's their thing. They can trade amongst themselves. It's absent government intervention. That's 100% nonsense. They say it's based on encryption and that's why it's valuable. Well, what encryption? Encryption that the NSA eventually is going to be able to crack, eventually be able to control. Virtual currencies can be created. You and I can create Ryan coin, smuggled coin, right off of the Bitcoin protocol because it's open source. There's a Ron Paul coin. There's even a Kanye West coin called Kanye coin or something. I mean, it's kind of ridiculous that
you can't make this stuff up, Kanye.
No,
you can't make it up.
People have moved. Originally libertarians were sound money people. They've cottoned on to the fact that with Bitcoin you can't create more of it, but that's just artificial scarcity. You and I can create a currency and say, well, there's only 300 million of them, and that's all that's ever going to be made. That doesn't make it attractive because the underlying value of it isn't there.
Well, I don't know if you saw this, but a Manhattan real estate firm, Bond New York, is now
accepting
Bitcoin as means of payment when buying a home. Yeah. So it's so interesting because now it's kind of like everybody, let's not focus on the dollar or anything like that. Let's start looking at these virtual currencies that people can just make up out of thin air, right? Just like you said. I mean, now, I have a bigger question for you. So I did say that I don't think anything's going to happen in 2016, but do you think that there's a potential possibility that the United States loses its status as the Federal Reserve currency, knowing that China and Germany, all these countries are trying to, pick up as much physical gold as they possibly can, and maybe all these countries start to team up and say, hey, look, I mean, this is ridiculous. I mean, obviously everything revolves around the United States like it always has. But do you think that there is a potential for that's where the one scenario that I could see could cause a disaster for us if that happened? But that's the only way that I see anything really changing.
I don't think China wants to be the world's reserve currency, but I think they want less reliance on the dollar, And I think it's already inexorably headed that way. When Germany asks for its gold back and the Fed says, it's going to take 7 years, why? That doesn't make any sense. Why did China import like 2,000 tons of gold in the last year and continues to import it through Hong Kong? The United States is basically saying we lost the Bretton Woods in 1971 when we went off the gold standard. We basically put all of our trust in our military might and the petrodollar, and now basically it's in the Fed and the Fed's ability, and those 12 governors to manipulate the economy and get it to do its bidding. But at some point, it's just like Bitcoin. The emperor has no clothes, because why do you need to believe in that? There's nothing behind it. Now, Bitcoin there's absolutely nothing behind it other than it's a system, it's a payment system, it's encrypted. Right. But at least the U.S. federal government has behind it a history of payment, a strong military, a formerly very strong economy, and a tradition that 70-80% of the world's international transactions take place through the dollar. Right. The real question for the dollar is, though, but why? Can't something else take its place? And slowly that's happening. Of course, you can use euro, you can use renminbi, but the reason people don't use those is they're just as fiat and just as thin air as the U.S. dollar is.
Right. There's really not a better system, right? I mean, there really isn't. And
but if China can actually start to boost, and even just not even boost it by gold, but just allow its currency to rise against the dollar. I mean, they branded a manipulator, which is kind of pot calling the kettle black, because the U.S. does the same thing, because they are keeping their value of the renminbi low so they can export. But once they allow their renminbi to go higher, then more people will value renminbi, the Chinese yuan, and more transactions will take place in currencies other than the U.S. dollar. Now, all that means is, again, that's good for gold and silver, because those are currencies that could be used that are really backed better than even what China is doing, or because you don't have the counterparty risk and the political risk. See, because with the dollar and the renminbi, is all based on policy. Are these guys going to be good stewards? Are they going to institute the policies that's going to protect the value of my currency? We don't know. And it's surprising the dollar still has value when they've gotten away with printing $4 trillion extra dollars out of thin air, based on no increased production, based on nothing other than
that's what I'm saying. There's no fundamentals behind anything. I mean, every bit of news that you see, I don't care whether they can make.
And it's fulfilling, Ryan, because gold and silver haven't gone up in spite of that. It's like, see, we can do this.
Yep. And it's like, okay, look at the stock market. Look where the stock market's at. Look, we still have mortgage interest rates up below 5%.
Bernanke is a genius. The Fed is great.
We still have rising home prices. Look, consumer confidence is going up. Look, instead of 19% people being underwater, now it's only 15%. Look,
and isn't the United States doing better than Europe? See?
Right. It has to be, right? It has to be, because
we didn't have Cyprus.
We haven't had Cyprus yet.
No, but that's the point. What all these changes are doing is saying that you guys don't understand. This is monetary policy. It's over your head. It's not printing money. It's monetizing debt. It's quantitative easing. It's good for the economy. It's rising stock prices. We're increasing consumer confidence. And if the longer they continue that, the more people believe it.
And that's why I feel like they can continue that. I feel like they really can continue that for another 2 years.
You're right. They have continued it.
They have. And
here's the problem, Ryan. When it stops, they will never blame their policies for why it didn't work. They will say it was working until whatever event happened, and then they'll say that was what the problem was.
No, you know what they'll do. There will be another war that's created out of thin air, and then they'll create a sideshow that's taking place when all we know that there's an utter monetary disaster going on, that they'll divert all the attention to a war where they can spend more money and which would create jobs temporarily. And this is exactly what takes place all the time, and I don't think that this time is any different. It's just a matter of what is the timeline, and that's what you and I don't have control over, and that's why we're sitting here having this conversation for where we see things.
Well, we're using logic on a small scale because this thing is so large.
I know
that there's really no historical precedent for it. When a federal reserve bank or central bank decides it's going to print its way out of trouble, yeah, we've seen it end in disaster in Weimar Republic, Zimbabwe, but those are little rinky-dink, small economic areas.
Exactly. They're not the Federal Reserve currency of the world, right?
Of the world, exactly. And as you've seen in Argentina, when little countries do it, or it happens in a small economy, well, it's hyperinflation, it's game over, it's obvious.
Right.
Not so obvious when you have the world's reserve currency, and people are basically bound to use the dollar.
And you have one of the basically the strongest military presence around the world, right? So
now look how long it took for use the Rome parallel. Rome started debasing its currency. It took hundreds of years, hundreds of years before Rome finally fell.
So we're talking about 4 trillion.
Now, things happen faster, in modern times, but this could take 20, 30 years.
Well, let's talk about so the Fed's balance sheet. Let's say 4 trillion. To you, it's just, and to me, isn't that just a number? Like, does it really matter whether it's 4 trillion or 40 trillion? Because
ultimately, it matters 100%. In the short term, it doesn't matter at all. Like when internet stocks were overvalued, and the stock price was $200. Well, it could be $300 too. It could be $400. It's going back to $2 or zero, but there's no reason it can't go to $1,000. Same with Bitcoin.
It's just like you said, right? We have companies like Facebook and Twitter and all these companies that are propping up. What actual value are they putting out there?
But once you get past value, when it's thin air, it could be anything.
Yep.
Once you've accepted the hallucination, and it's temporary, that Bitcoin is worth $1,000, the U.S. government, the Federal Reserve can print $4 trillion, well, then Bitcoin can go to $10,000. U.S. Federal Reserve can print $8 trillion, and the stock market can go to $30,000. Why not?
Yeah, so I mean, our economy
you're already overvalued. You're already playing with made-up, make-believe numbers. You can go wherever it wants to go.
That's pretty funny. Our economy is based of mainly hallucinations about what's taking place in our economy.
Right, and you can go on multiples of that. Once you've accepted the hallucination, it doesn't matter. And that's, I guess, what ties into your belief that we can continue this for another couple of years.
Yeah, as much as I don't.
Because we shouldn't be there now. It should be over now.
We shouldn't be where we're at today.
Right.
You know what I mean? And the fact that we are, gives me pause and thinking, things got to get worse, right? I mean, it's got to happen this year. I mean, it should have happened last year. Should have happened the year before that. So it's like
once you've suspended belief for 2 or 3 years, you can suspend it another year.
Absolutely. And I think that's exactly what they've created, and they know that. The psychology behind what's taking place between Congress and the Federal Reserve, they're master manipulators of the public, right? So as long as they can keep this train going by putting out these beliefs, putting out these economic reports, letting people know that consumer confidence is good, I mean, they can keep this going for 10, 15 more years. We don't know, right? Should it go that long? No. But can it? Sure.
Hey, if you ask people in October 1st, 1929, how things were, they'd have projections, how wonderful they were, how 1930 was going to be a huge year, 32 was going to be even better. When you're in that position, you don't see in front of you. You see what's going on, everything is good, but everything is good. You're about to hit the iceberg, you don't see it.
So, obviously, then both you and I have gold and silver prices going higher in 2014. Stock market, I feel like it's pretty much gonna stay the same. If not go higher from here. So for what about the virtual currencies and such? Do you see those just having just huge disparity between highs and lows there? It continues to be manipulated like it has been from the start?
Well, it depends on Bitcoin and the rest. They can go to $2,000, $3,000, $4,000. The problem with those are the hallucination isn't mass. It's small, and I don't think it'll spread to if it spreads to the mainstream, Bitcoin can end up being a stable. When I say stable currency, I mean a staple currency.
Right.
And if enough people start to believe it, and they've suspended belief long enough, then it's here to stay, and it will have a high valuation. However, if it does achieve that, there'll be so many other coins off the same protocol that eventually the unit values of Bitcoin will come right back down, because if all you're going to use is to transfer money or to get accepted at a real, you don't need to hold on to a Bitcoin, which means you don't need to hold on to it. It means you sell it, and you can always put your money into any other virtual currency when the need arises, and you don't have to pay $1,200, $3,000 a Bitcoin to do so. So it won't be a store of value. It'll just be, if everyone uses it and there's 1,000 different virtual currencies, then there's no reason for Bitcoin unit value to be that high. But until then, the price could go higher. I think it's close to worthlessness, meaning that if it's open protocol, it should just be the cost to get onto the system, and that's about it.
Right.
You shouldn't have to pay for the additional coin to use it. It's just basically you're just transferring money, and if it's $800 today, why should it be $1,200 tomorrow? Why should it be $400? It needs to stabilize, but not at a high price. It needs to stabilize at a lot lower, because if it's too high, there'll be other currencies that you can get the same trick done just as easily.
Yeah. Yeah, and, so in the grand scheme of things, knowing all this and how we always pull this back into real estate and what our show is all about and pulling in the economy. So if we really think that the stock market's going to be, continue to be propped up, if we feel like gold and silver is going to move up a little bit higher, we think real estate prices are going to stay relatively the same. We're still back in the same boat that we have been for the last few years, Louis, which is we still have mortgage interest rates that are sub 5%, right? So there's still...
You can't go wrong with real estate long term. That's if.
You can't, right? Because you do have that hard asset there, right? It's not like Bitcoin, which is a fictitious thing they just made up out of thin air. You do have a hard asset like gold and silver. You really do have something there. And I think that's the big point for 2014.
In uncertain times, you need to have real stuff.
Absolutely, and I think that's the biggest point. We're not financial advisors or anything like that. We're just talking about our opinions here. But in 2014, if you have the ability, if you have the means to be able to buy these type of assets, then I think you should. You can protect yourself from future inflation. Now, when is that inflation going to really double or triple? I mean, we've already seen it on the level of gas prices and food and things like that. The things that the consumer CPI factors out. But if you're able to lock in yourself in a 30-year fixed mortgage at sub 5% levels, you're protecting your long-term financial future by doing that.
And most people right now, though, when things are going higher, like Bitcoin in the stock market, people aren't interested in preserving their wealth. They're interested in doubling it and tripling it easily.
Yeah, and I think that's what
that comes to an end. All these bubbles come to an end.
You know what? Yeah, it always does, and it always ends up that somebody lost half their portfolio, right? Because they got a little too aggressive. And I'm sitting here looking at the headline on CNN Money. It says millions miss out on soaring stock prices. Really? It's what.
Well, what about all the people quote kicking themselves because they missed Bitcoin? So they're in there now buying it for $1,000. They don't even know why they're buying. They're buying it because it's going up.
Or they're buying Kanye West's coin at this point, right? Because they're like, well, if Bitcoin went up, Bitcoin has to go up.
I got to get me some of that stuff.
Me too. So
Kayne coin, Kanye coin.
Kanye coin. I definitely got to get at least one of those. But we're coming up on the end of the show, Louis. I want to thank you, as always, for
Thank you.
If you wouldn't mind giving our listeners your website so that if they want to contact you with any questions, if they want to check out your blog, tell them where they can
sure.
go.
You can go to smallgold.com. We have a Small Gold YouTube channel, smallgold.com website, blog posts every other day, and also you can follow me on Twitter. It's smallgold at Twitter.
Great, Louis. I appreciate it as always.
All right, Ryan. Thank you.
Thanks, guys, for tuning in. Remember to check us out on iTunes. Search Real Estate 360. You can subscribe there. Please leave any reviews. Share with any friends that you may have out there that may want to listen to a real estate podcast like this and help us continue to grow. You can also check us out on our website to stream there as well at realestate360live.com. Until next week, guys. Take care.